Hey everyone, welcome back to Corporate Dakota. Today, HWKINS Incorporated just filed their quarterly report on Form 10Q for the period ending the 28th of June 2026, and I am seeing some interesting shifts in their financial health. Quick note, this is not financial advice, just my take on public filings for educational purposes. HWKINS is showing solid sales growth, but margins are under pressure, and they made a significant acquisition. Let's dive into what that means. Alright, first up, this filing is for HWKINS Incorporated, a company that makes and sells chemicals and ingredients. They operate in a few different areas like water treatment, food and health sciences, and industrial solutions. Looking at their balance sheet on the 28th of June 2026, we see some key numbers. Total assets are over $1 billion. That is a big number reflecting the size of their operations. Let's look at liabilities. They have long-term debt of $244 million. That is a pretty stable amount compared to the previous quarter. Now let's talk about the money coming in. For the 3 months ended the 28th of June 2026, HWKINS reported sales of $315.7 million. That is a good increase of about 8% from the same time last year when sales were $293.3 million. This growth seems to be happening across all their business segments, which is a positive sign. They are selling more products in water treatment, food and health sciences, and industrial solutions. But here is where things get a little tricky. While sales are up, their gross profit, a measure of how much money they make after directly producing their goods and services, is up only slightly. Gross profit was $74 million for the latest quarter. That is just a small increase from $72.4 million a year ago. What does this mean? Well, their gross profit as a percentage of sales has actually decreased. It is now 23% compared to 25% last year. This tells us that the cost of making their products is going up faster than they can raise prices. They mentioned higher freight costs and something called LIFO reserve increasing, which also pressures their margins. For example, in their water treatment segment, gross profit is up, but as a percentage of sales, it is flat. In food and health sciences, gross profit is flat as a percentage of sales, even though sales are up. And in industrial solutions, gross profit as a percentage of sales is down. On top of that, their selling, general and administrative expenses also went up. They were $35.3 million this quarter, up from $31 million a year ago. A big part of this increase is due to costs from new businesses they acquired. They also had a one-time positive adjustment last year that made expenses look lower then, so the comparison this year shows a bigger jump. All of this means their operating income, which is their profit from regular business operations, took a hit. It fell to $38.7 million from $41.3 million in the same period last year. That is about a 6% drop. Now about those acquisitions, a big one they mention is the purchase of Water Surplus Incorporated on the 25th of April 2025. This was a substantial deal costing about $149.9 million up front, with potential for more money later based on future profits. Water Surplus focuses on sustainable water treatment solutions. This acquisition is included in their water treatment segment. They also made several other smaller acquisitions in fiscal 2026 and the beginning of fiscal 2027. The total revenue from these smaller businesses acquired in fiscal 2026 and early 2027 was about $52.3 million. And when you buy a company, you often have something called goodwill on your books. This is essentially the value of the company beyond its tangible assets. HWKINS has a lot of goodwill, growing to $223.8 million. A big chunk of that $171.7 million is in their water treatment segment, reflecting the Water Surplus acquisition. They also have significant intangible assets like customer relationships, trademarks, and technology. These total $229 million. The customer relationships alone are worth over $205 million. Let's look at cash flow. Their cash from operating activities was $35.2 million for the 3 months ended the 28th of June 2026. This is up from $31.5 million a year ago. That sounds good, but remember their profit from operations actually went down. This cash flow increase is mainly due to changes in how much inventory they hold and how quickly they pay their bills. Investing activities, however, used up a lot of cash. They spent $14.9 million on investing activities compared to a massive $164.5 million last year. That big number last year was largely due to the Water Surplus acquisition. This year, capital expenditures for things like property and equipment were $11.6 million, which is less than the $13.5 million spent last year. Financing activities show a big swing 2022. This year they used $16.1 million. Last year they provided $142.5 million. The main difference here is that last year they borrowed a lot of money, about $150 million, to fund the water surplus acquisition. This year they repaid some debt and also repurchased $7 million of their own stock. Speaking of stock, they mentioned repurchasing shares. They are authorized to buy back up to 2.6 million shares. In the most recent quarter, they repurchased about 45,000 shares for $7 million. They are also seeing shares granted to directors and employees. Now, for a really interesting part, the company uses a system called fair value hierarchy to measure certain assets and liabilities. For things like their earnout liabilities, which are potential future payments related to acquisitions, they use what is called level 3 inputs. This means they rely on their own internal models and assumptions rather than observable market prices. The water surplus earnout liability is valued at over $45 million, and they adjust it to fair value each reporting period. This shows a level of estimation in their financial statements. Their income tax expense is also worth noting. For the 3 months ended the 28th of June 2026, their effective tax rate was about 24%. Last year it was 25%. They mentioned favorable tax adjustments in both periods. So what is the story here? Hawkins is growing sales, which is great. However, their profitability is being squeezed by rising costs, and they are actively acquiring companies, which adds complexity and requires careful management. The water surplus acquisition is a significant move for their water treatment business. The fact that their operating income is down despite higher sales is a red flag that suggests they are not able to pass on all their increased costs to customers. Alright, that is my take on HWKN's Incorporated's latest filing. What do you think about their sales growth versus margin pressure? Let me know in the comments. If this analysis was helpful, please like this video and subscribe for more. You can find the tools I use for this research linked in the description. That is my take. Stay decoded. And if you want to support the channel and get access to the tools that help me make these videos, check the description for affiliate links. Like, comment, subscribe, and join our Discord.